We're excited to welcome you back on our channel, Thailand Asia News and Travels for today's Thailand news, and extend a warm welcome to new viewers. Stay informed and don't miss anything. Subscribe now and be part of our community. For decades, Thailand has been a haven for expatriates, particularly retirees from Europe seeking a tropical paradise with a low cost of living. Among these, Dutch and Belgian nationals enjoyed a significant advantage, a tax treaty exempting their pensions from Thai income tax. This perk, coupled with Thailand's affordable lifestyle, made it an irresistible destination. However, this era of tax-free living is coming to an end. Recent changes in Thailand's tax policies signal a shift towards greater scrutiny of foreign income, particularly for long-term residents. This move, while seemingly abrupt, is rooted in a global trend of nations seeking to close tax loopholes and ensure a fairer distribution of the tax burden. For Thailand, the change is partly motivated by a desire to curb tax evasion among wealthy Thais, who often channel income through overseas accounts. The new regulations aim to create a more equitable system where both residents and long-term foreign residents contribute their fair share. This shift, however, has generated considerable anxiety among expats who have structured their lives around these tax advantages. The new regulations are part of a broader effort by Thai authorities to modernize the tax system and align it with international standards. These changes include stricter enforcement of existing laws and the introduction of new measures to combat tax avoidance. The move towards greater tax transparency is not unique to Thailand. Many countries are grappling with similar challenges posed by globalization and the increasing mobility of capital and wealthy individuals. The decision to end tax-free perks for some expats is driven by Thailand's commitment to fiscal responsibility and a more equitable tax system. For years, the Thai government has grappled with revenue shortfalls, impacting its ability to fund essential public services and infrastructure projects. The preferential tax treatment enjoyed by some expats, while seemingly beneficial, contributed to this imbalance. By closing these loopholes, Thailand aims to create a level playing field for all residents, ensuring everyone contributes proportionally to the nation's development. This move also aligns Thailand with a global trend of cracking down on tax avoidance and promoting greater financial transparency. The Organization for Economic Cooperation and Development, OECD, a key intergovernmental organization, has been instrumental in pushing for these reforms. The OECD's Base Erosion and Profit Shifting (BEPS) initiative aims to combat tax avoidance strategies employed by multinational corporations and wealthy individuals. Thailand's decision to end tax-free pensions for certain nationalities is a step towards aligning with these international standards. This shift signals to the world that Thailand is serious about tackling tax evasion and creating a fairer system for all. This move is expected to not only boost government revenue, but also strengthen the integrity of Thailand's financial system. Central to the new regulations is a stricter interpretation of foreign income tax laws. Previously, the tax code offered leeway in how foreign income was classified and taxed. However, recent clarifications by the Revenue Department signal a move towards a more stringent approach. This shift has raised concerns among foreign residents, particularly those who rely on income generated outside Thailand. A key point of contention is the definition of residence for tax purposes. While previously determined by physical presence in the country, the new interpretation considers factors like family ties, financial interests, and the purpose of stay. This broader definition could potentially draw a wider net, subjecting more foreign residents to Thai income tax on their global earnings. The lack of clear guidelines on these new interpretations has created uncertainty and apprehension among expats. Many worry about potential double taxation, where they might face levies on the same income in both Thailand and their home country. This uncertainty underscores the need for clear communication and comprehensive guidelines from the Thai government to alleviate concerns and ensure a smooth transition to the new tax regime. Navigating uncertain tides, Expat Concerns. The lack of clarity surrounding the new tax interpretations has understandably fueled concerns among foreign investors and expatriates in Thailand. Many have expressed worries about the potential for double taxation, especially those who draw income from multiple countries. The absence of concrete guidelines on how these new rules will be applied has created a sense of ambiguity, making it difficult for individuals and businesses to plan effectively. This uncertainty has the potential to impact foreign investment. Investors thrive on predictability and transparency. When tax laws are unclear or subject to sudden changes, it can deter investment, especially in sectors like real estate and tourism, where foreign capital plays a significant role. A decline in foreign investment could have broader implications for the Thai economy, potentially impacting job creation and economic growth. Addressing these concerns is crucial for Thailand to maintain its attractiveness to foreign investors and skilled professionals. Clear, concise and readily available information is paramount. Expats and investors need to understand their tax obligations and plan accordingly. Open communication between the government and the expat community can help alleviate anxieties and ensure a smoother transition to the new tax landscape. Charting a course: Thailand's roadmap for clarity. Recognizing the concerns raised by the expat community, the Thai Ministry of Finance has pledged to provide greater clarity on the new tax regulations. The ministry plans to engage with stakeholders, including foreign chambers of commerce and expat associations, to gather feedback and address concerns. This collaborative approach is essential to ensure that the new rules are implemented fairly and transparently. The Ministry of Finance also intends to issue comprehensive guidelines outlining the interpretation and application of the new tax laws. These guidelines will provide much-needed clarity on key issues such as the definition of residence for tax purposes and the treatment of foreign-sourced income. By addressing these grey areas, the government aims to create a more predictable and transparent tax environment. In addition to clarifying the rules, the Thai government is also taking steps to facilitate compliance. The Revenue Department is enhancing its online platforms and services, making it easier for taxpayers to file their returns and access information. The government is also investing in taxpayer education programs to increase awareness and understanding of the new tax laws. Global echoes. A look at similar tax shifts. Thailand's move towards stricter enforcement of foreign income tax is not an isolated incident. Countries worldwide are grappling with similar challenges posed by globalization and the need to ensure a fair and equitable tax system. Many nations are implementing measures to close loopholes, prevent tax avoidance, and ensure that everyone contributes their fair share. For instance, the United States, with its Foreign Account Tax Compliance Act, FATIA, requires foreign financial institutions to report on accounts held by US citizens and residents. This legislation aims to combat tax evasion by US taxpayers using offshore accounts. Similarly, the European Union has implemented various directives aimed at preventing tax avoidance by multinational corporations operating within its borders. These global efforts highlight a growing consensus among nations that a fair and transparent tax system is essential for sustainable economic growth and social equity. By aligning its policies with international standards, Thailand is not only strengthening its own fiscal position, but also contributing to a more equitable global financial system. As the world becomes increasingly interconnected, international cooperation in tax matters will be crucial to prevent tax avoidance and ensure that everyone pays their fair share. This was one of today's headlines in Thailand. Check back tomorrow for more news and updates.